Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
Alright folks, you're on the Property Couch where each week Ben and I bring you the insider's guide to property finance and money management. Hello mate.
G'day mate, how you going?
I'm good, how about you?
Yeah, no, all good. You're tired, but all good.
You were in Picker you weren't in Picker, you were in Brisbane.
Brisbane for a Picker meetup.
Was that Brisbane then?
No, Brisbane.
Did you say Brisbane?
No, I didn't say Brisbane.
You were in Brisbane last night.
I was, Brisbane.
Yes, how'd you
go? Good, it was a great night. We had probably just over 100 people there.
Yeah.
Cameron Cusher delivered a fantastic update in terms of what's happening in the market. Some great questions, really good questions around should I buy now, before, and I said, well, it's an interesting question, right? Because I think that we could put a baseline of demand through the system if we see lower interest rates. You've heard it here first. I'm having a stab in the dark. You ready?
Yep.
So I think the Liberal Party will announce a first homeowner scheme at some point during this election.
You flagged that a couple of weeks ago.
Oh, did I?
Yeah.
Fantastic.
Because remember when the budget you said, oh, there's a sneaky little unspent amount of money.
There is $3 billion unannounced.
And you sort of went, oh, I reckon that's
could be.
a first.
Okay, so my bad. I don't know where I've said it. I've been
speaking. That's right, mate, because you haven't slept much in the last 2 weeks, so we'll pay you that one.
And then, the last one is if APRA adjust their servicing calculator down, so more people will be able to borrow a reasonable amount of money. So I think those things will actually put a base under the property market. We won't see further falls unless we see the negative gearing changes, right? So this bounce.
I think you should say to anyone, should you buy now? The answer is no, because our team is out there picking up some amazing properties. So it'd be great for there to be no competition. We
want everyone the opportunity. Jump in and put it beyond doubt. All right, put it beyond doubt. Get that negative gearing benefit.
Well spotted. So hey, we're all keen to hear the update, mate. How's your chase for the biggest story in the election so far?
Well, yeah, we've had also some. On Sunday I tweeted, where's Wally? Where's the negative gearing policy on the ALP's website?
Where was it, Ben?
It was gone, Bryce. It was taken down because their numbers were wrong, Bryce. And so now they're waiting on the PBO, the Parliamentary Budgeting Office, to actually redo the numbers. So
it's not bad for just a mortgage broker, Ben, who's now caused them to pull down some stuff on the website.
So here's the deal, right? So I've also said, okay, well, if you're going to do that, are you consulting with industry yet? Have you learnt your lesson?
Yeah.
And it doesn't look like they're consulting with industry, because I haven't heard anyone from the Masters Builders Association, from Property Council Australia, from CoreLogic, or anyone being contacted by the PBO. So that's a little bit disappointing, because we're pretty much sure the numbers are landing around 45%,
yep.
Brand new. And Cameron was talking about last night that there's 150,000 new apartments that are going to be settling in the next 12 months, right? So the vast majority of those have been bought by investors as well. So what are they doing? And then, now that they understand that it's not going to give this spike and already it drives supply, how much buyer behaviour adjustment are they going to do, in the sense that of the current buyers, people are going to turn away from property completely and go and invest their money somewhere else. So I'll be fascinating to see. So I'm calling on Labor to, they said they're going to have some numbers updated by the PBO, but I still think they'll be loaded. Yep. I don't think they'll be the truth, because if they haven't contacted the industry, then where are they getting their insights from? And if they aren't loaded, and we have, say it's 45% new currently, what does that look like? And then my next question to them is around buyer behaviour. So what factors have you put in there, given that investors already are happily buying it and they're not going out the other side? So, that's the thing for me. So let's wait and see.
So a quick recap for someone who's listening to us for the first time, Ben.
Yep.
The initial call was only 4%, then it went
Correct.
to 7%,
Yep.
then it went to 22%, and you're calling them out that it's 45%.
Correct.
Just quickly, 25 words or less, what impact will that have on their election pledges?
So the bottom line then is that the revenue doesn't come through. All right. So what we've seen in their original statements was 25,000 new jobs, and originally they were quoting $32 billion in future forecast revenue. That went as high as $35 billion. So then now that's at question, right? Now, when you've got the Masters Builders Association coming out saying, their models suggest that this policy will reduce the property market by 42,000 new builds. That's crazy, right? It'll also drop up to 32,000 new jobs will be impacted by that, and $11.8 billion in negative economic benefit.
Okay.
So robbing Peter to pay Paul doesn't quite work. So I think, logic is starting to come out, and I think this policy is going to get a review. It has to.
Now you also, Ross Greenwood gave you a second run.
Yes.
On Monday?
Yep.
No, Tuesday.
Yeah, and that was on the back of, their policy document had changed significantly and their language is being changed. So their language is now language around still the 5 or 6. So that's complete spin. We know that. Remember, about 19,000 people, buy 5 properties, and 6 or more properties is 20,357. So we talked about that, only a 641 increase. So I think that message shouldn't get cut through because it's such a small portion. It's not a significant number. And the other thing they're also talking about is, but we still want this money for schools and hospitals, right? So they're still on message there. And so watch this space. Picker will be releasing some models around showing just how much tax an investor does pay over the journey at both federal and state level. And so that money will be foregone if investors don't play in this space. And so we'll keep saying property prices are going to go down and rents will go up.
So the Stig reached out to the producer of the Ross Greenwood show. They were kind enough to let us replay those. So for those of you who haven't heard them, they're in our catalogue of episodes. So check those out, Ben. So well done. Hey, before we go into the meat and potatoes of today's show, Ben, the footy tips update.
We can hear Ivis having a little giggle there.
I called Ivis out before, as you well know, Ben, because she was seriously heckling me because she is smoking it on the ladder.
She's doing all right.
And
she's up there.
And I'm not. So,
so where are you, Bryce?
Well, I don't think it's important.
Are you in the top?
I'm in the mix.
Half?
I'm in the half of something.
So for those
where
people
am I, Ivis?
260.
Do you know what her response was, Ben? She goes, "Well, I'm not going to talk on the podcast, but at least I can talk on Facebook."
Ultimately, there's a bottom, right? There needs to be someone close to the bottom. And,
come on.
And are you what? 20 from the bottom, 30 from the bottom?
I wouldn't have thought I was near the top, would be the answer.
So are you 6 from the bottom or something like that?
So what I should do is probably announce what my nickname is so everyone can see for themselves. So Fife, as in the captain of the Fremantle Football Club, now Fife.
Yep.
So you can go and check out where I am. I'm not on the bottom, but let's just say I'm in the shadows of the bottom.
Yeah.
But anyone who's tipping well in this environment, seriously, they're just throwing darts.
Be careful.
They're just throwing darts.
No, they just might know the sport better than you. And for those of you who don't know who I am, because I'm not doing much better, I'm about the middle of the pack.
Yeah.
I'm Gandhi.
Yeah.
Okay, so for those of you who get the link,
Ben
Academy
Kingsley,
Award winner Ben Kingsley. That's it.
Yeah.
Oh, there we go. So that's why I'm Gandhi.
So because you're smoking it, I mean, you're like a whole 3 tips ahead of me. So well done on that. Yep, nice work.
And I didn't even tip in the first game. I forgot to. So there you go.
Hey, there's someone. Did we highlight Stig for Prime Minister before? Yeah. Okay. Well done for that one. I don't think that's appropriate.
All right. So who was our winner for this round, Bryce?
The winner was I Want the Armchair Guide.
Oh, well done. I Want the Armchair. Guess what?
So the question is, which book do you want for winning the round? I think there's a little clue there. But just in case we're making assumptions, Ben, reach out to Stiggy at info@thepropertycouch.com.au and let her know which book you want. But I think it almost speaks for itself. And then second place Beachy, third place Speak Greek, Sound French.
Perfect.
That's a long time listener, Ben.
That's definitely.
That's someone who's been listening from the first 100 episodes.
And there's someone fried rice in there as well. And so I'm just sort of seeing if there's anyone with dark chocolates and almonds.
Yeah.
That would be also a good name if anyone wants to join, because you can still win each round, right? There's still prizes for each round, as well as the overall prize, which is a property portfolio plan, so worth just under $5,000. So it's a damn good price to win.
It is a very good price to win. Okay, today my mindset minute today, Ben, is we put out a competition. Taria Pitt was a wonderful guest a few episodes ago, and she sent us some books and we're going to give them away, Ben.
Yep.
And what we did is we said we'd go on Facebook, give us the top takeaway. We have a range of them. So everyone's going to get a book.
Great.
But the first one is from Andrew Odell. My biggest takeaway is that one mistake doesn't mean it's a failure. It's all part of the process of learning. This is true for all aspects and stages of ours and our kids' lives.
Beautiful.
Thanks for the podcast. So, Andrew, let us know. We'll send you a book. Second one was from Sandy. My goodness, so hard to choose a favourite. I wrote down so many and have listened to the podcast 3 times, Ben. 2 quotes I loved were either you run the day or the day runs you. I totally believe in that.
Yep.
And secondly, I dictate the narrative. And I remember her saying that because there's a question to me about people projecting their stuff onto her. So much gold. So Sandy, reach out to us. Well, in fact, let's be honest, Ivis, and she will get you a copy of the book. Third one is from Nicola Falconer. I can't read your writing, Ivis. There you heard her.
Yeah.
She had so many inspiring quotes, but I also love the one where she turns around a negative, I have to I get to. A great way to not take your life for granted. Nicola, send us a note. We'll send you one. And the fourth one was from Braden Holmes. Takeaway: be thankful for what you have and wake up every day trying to be better. Thanks for the podcast, B&B.
Love it.
So those 4 people, please reach out to Stiggy, and she will arrange for a book to be sent to you. However, everyone gets a prize, man.
Everyone gets a prize.
So the people who weren't chosen but also get a book is Zoe Crowder. Consistency, simple but so true. So that was her takeaway. So Zoe, will send you one of our books. Mark Wood said, ask yourself if you're doing the work. The more you do the work and more steps you take, the more you realise what you're trying to achieve. Maybe it is possible.
Beautiful.
Good one, Mark. We'll get a book to you as well. Scott said, love her comment about stretching the boundaries of your comfort zones. Too easy to just stay safe. Love it, Scott. Send you a book too. Jeanette Lyons also said, I get to. Best mindset shifter.
Yep.
So we're going to send one to you as well. So there you go, folks. Thanks for participating. We're going to send you all some books, which is great. Hey, today, Ben, we...
Part two.
Back
Back to Julia.
to Julia Hartman.
So tax, it's all tax. It's tax is a big thing.
Yeah.
Yeah, the tax is on everyone's mind.
It's the theme of this period of time in Australian economics and politics. So here we go to our part 2 with Julia Hartman. All right, we're getting through a few here, Ben.
We are.
Now, we've pivoted here to some, I guess, broadly ownership and trust related questions because we get a lot of those. Julia, what name should I buy in? Should I buy it in a trust? Should I buy it in a company? And I'll be interested to see what your feedback is as we go through some of these questions. But it's interesting to note that in my experience, and you might all have an opposing view, but in your own name is straightforward for a number of reasons because it's easier to get the lending. It's more straightforward. It removes complexity. But as your level of complexity with your tax gets higher, the more you start having to introduce sort of different structures. But as a general principle, what would be in your 3 decades of being exposed to property investors, what would you see as the majority of entities that people buy in outside of their own name? Self-managed super fund companies, trusts, what do you see the most?
Right. Self-managed super funds are an excellent idea for buying property if you can afford to lock your wealth away. But it's now getting very, very difficult to get loans for them. So if I put that, but they're just fantastic for the tax breaks, for the planning, for effectively negatively gearing by making super contributions to offset it, you name it. They're great. Trusts have changed. The whole thing's gone out the window. If Labor gets in and they introduce a minimum tax of 30, why do you think the book's out of date? Of 30% as a minimum tax rate on trust distributions. Imagine buying a property in a trust now, because it does give you a bit of a distance between you and the tenant. So a bit of asset protection, but you buy it in a trust now, then you go and retire and it's positively geared and suddenly you've got this you're losing 30% of your net rent and you wouldn't have to pay any tax if because you've got so little income. So they're a real worry now, trusts. I'm sort of going, what do we do? And companies are no good because they don't get the 50% capital gains tax discount. So it's becoming very difficult to advise on this.
So which makes for a good point. I mean, you know, we've all been around long enough for certain tax programs and tax incentives and tax schemes that we've seen over the journey, you know, hybrid trust structures and so forth. I mean, what's your view on those, Julia?
Oh, you should know. I used to rant and rave something fierce in the day.
I know, but I just want the listeners to know.
Well, look, even when they came out, it was clear there was already a case, there was already rulings that they couldn't. You can't do it. You can't pick and choose whether you get both sides. So anything that suggests that you don't have to have the capital gains tax consequences of the growth, but you can get the negative gearing, just go, run a mile.
Scare. So any type of tax scheme, and all you need to Google is the Hart case was different though. That was interest capitalisation. Do you have a view on the interest capitalisation work that was also done?
Yeah, well, I'm more inclined to support that argument.
Yes.
I mean, there's a lot to be said for it, and I can tell you that, there is a case where they've, rather than take it to court, the tax office has allowed taxpayers to continue to capitalise interest because they were pretty sure they were going to lose in court. So, but they had to sign off confidentiality to be able to do it. So yeah, capitalising interest is, you know, it's as long as you don't do it with the dominant purpose of a tax benefit, that's your issue. And that's what this person could get around. They had another purpose for doing it. You can't afford to make the interest payments, then you can borrow to pay the interest.
Yeah.
You know, they can't, that's not dominant purpose, is it, of a tax deduction? It's just getting by.
That's survival.
You know?
Yeah, well, I mean, look, we're now getting into some sophisticated areas, and we would say, obviously, to go and speak to your professional tax agent if you are looking. If someone presents to you from a property investor's point of view, how you can control an asset by using equity and getting a line of credit and interest capitalising, that is a tax scheme. And if the purpose is for tax avoidance, run a mile. Okay, so you wanted to say something there, Julie, go for it.
Yes, well, that's the whole point. It's not worth the battle. And certainly if you're doing it for the dominant purpose of a tax benefit, you're not going to get it anyway. But the battle's never going to be worth it, even if you think you can, you know.
It's not the hill you want to die on.
No. So I think what we're hearing from Julie is that in the summation of some of these questions, you know, sensible approaches, say, you know, personal name at the moment, or you're also sort of advocating potentially, again, case by case, go and speak to a licensed professional, but self-managed super fund.
Decent borrowings and a decent interest rate, yes, that's your problem. And again, you need the whole plan worked out to see, well, you know, how long are you going to lock that away for? Can you support it? Are you well enough diversified? Yeah, they're big. Whenever I have a client go into a self-managed super fund, back when the Big Four were lending for them, I say, if you want to do this, no whinging's allowed for the next 6 months because it's going to get messy, it's going to be difficult, and you're not allowed to whinge.
Well, we always say to everyone, if you're not very comfortable and organised with money management, if you want to take on the responsibility of being a trustee, if you want to take on all the regulation and framework and everything, because remember, you can outsource the management, but you cannot outsource the responsibility. And in most cases, we say to people, it's not appropriate for you because of exactly those reasons.
Hey, we've got a few questions here that some of it we've just covered, but in terms of giving you an opportunity to fill in the blanks, there's one here from Ben Adamson. When investing for the long term as a couple, with one partner's income considerably higher than the other, what are your top tax tips to consider when determining ownership and borrowing structures?
Right. Well, we've already eliminated self-managed super fund companies and trusts, haven't we? We've done it. So now we've got which one, the high income earner or the low income earner's named abiding. So that's when you do the favourite thing, crunch the numbers, work it out, do some what if analysis, say, well, if rents go up 2% a year, eventually it's going to be positively geared, or work all those things out. and go, well, hang on a minute, the high income earner is going to be retired by the time it's positively geared. That's okay, we'll put in the high income earners. But if you say it's only going to be a couple of years and it's going to be positively geared, we might put it in the low income earners. Or the roles can change. The high income earner may be a female that's going to give up work to have children, so it's just very, but until you know the numbers and can do some reasonable forecasts, you can't tell which one.
Case by case.
Yeah, totally. Because you might want to have a scenario where you sell an asset in a time when someone's on maternity leave, for example, and their income is lower. So, but generally speaking, as a rough rule of thumb, you'd want to buy early into the higher income earner's name. This is if you've got an accumulation of a number. There will come a point when your taxable income is at parity, and then you'd want to reverse the ownership so that over time there's a mirroring of properties in the portfolio. So say it was 90-10, then 60-40, and then you flip it the other way so that eventually, once you've met the same taxable income, that you'd flip it. Is that a reasonable sort of big picture helicopter view?
Well, a trust would let you do that because you can change the distribution, but won't let you negative gear. But what you're talking about is here, if you're going to change the ownership, that's selling part of the property to the other person.
So in terms of multiple properties, so the first one might be 90-10 and the fifth property might be 10-90, for example. So at some point you'd want to change the ownership structure if you were investing over 10, 20 years and you were planning on buying more than one. That's probably more than what I was trying to hint at there.
Yeah, well, each property would have to be evaluated on its own circumstances and the crystal ball at that time, because that's what it is.
Yeah, very good. Thank you. Thank you, Ben, for that one. Lockie has said, what is the best tax structure for being able to keep borrowing, in brackets, family, trust or company? Buy, build and rent out for passive income. Thanks, guys.
Right. So borrowing is the main ability, and just said that you said that, Bryce, that it's easier to borrow in your own name. There's no doubt about that. And we've just eliminated all those structures for various problems, haven't we, at the moment? The best thing is to wait and see where the Labor gets in. And then we'll go back and revisit this.
Or grandfather the rules if you're in a position to do that now. So, okay, Lockie, hopefully that's...
No, that 30% tax rate, the grandfathering won't help you.
Okay. Good
point. And I think in some cases, with the accountants that I've worked with in the past, the considerations is one of asset protection as well, though, isn't it? So when you're having a general conversation with a prospective client, Julia, are you having that asset conversation around structures as well in high risk industries or employment?
Well, that is my problem now, and that would be the thing to move it to if we're not wasting too much in the way of negative gear, or we've got some. But at the moment, I'm backing right away unless they say they're only going to hold it for a few years. It's really awkward, and that's where super fund does give you the best of both worlds. It does give you very good asset protection, and you can negatively gear by effectively making a contribution to the super fund to offset the losses. So at the moment, it's basically in your own name or just wait. Wait.
We're having a little bit of technical problems with the audio here at the moment, but as you said, trust, it went blank. So I just wanted to, as people are listening to that and they say, if you buy it and up, beep, that was trust, is what you said. So,
okay.
Yeah.
Right.
It's a trust, Ben, on that one. It was a trust. CL Wong Troy, should we open a company to manage all the residential properties or a trust perhaps? If so, what are the tax benefits? I think we're
getting the message.
Certainly covered that, but we wanted to make...
No, because this is a different issue, because they're talking about having a company or a trust to manage their properties. So we're not talking about a house locked away in the trust that would cost the stamp duty and capital gains tax to get out.
You're talking about, you've read this to believe that they're in the business of property as opposed to in, a hobby business, which is residential property.
No, I took the word as managed, as in to go around and do the repairs and to collect the rent and stuff like that. That's what I took out of that question.
So if that was the case, then it's just your standard rules applying as a business going concern, right? Versus if it was buying investment properties within those structures.
Yeah, so we've got a separate business that doesn't own any property, so we don't have to worry about what's going to happen when you retire. So you might do that to try maybe and claim your you travel to your rental property or something. But what you've got to concern yourself is that whether it's personal services income. And if it is, so here you are in the simplest form with a rental property, your company's charging you to go and repair something and you're doing a markup. It's got to be market value, obviously, and it's over here in the company. Well, you can't distribute that to someone else because you went and did the repair anyway. It's your personal services. So you're just going to get the deduction in this part of your tax return and the income in that part of the tax return. So, and all it's going to do really is just achieve a lot of accounting fees. So strongly recommend.
So there you go, C.O. Wong Troy. Two sides of your question there being answered, which is pretty cool. Alistair Boyd, how to transfer properties between entities, in brackets, company to trust or company to personal name. Investigate how the Family Law Act interprets this. Thanks. Julia.
Okay. Well, as you're probably aware, the Family Law Court can get its claws into just about anything and say, well, no, it's matrimonial property, that's it, or we go in there. Now, there are bloodline trusts that you've no doubt heard of, and they're designed to say, well, no, it can never go to, like the parents set it up and say it can only go to our children, not their spouses. Now, if they do work and do protect the person, that the assets in that trust, then all the Family Law Court do is say to the spouse that's not in the bloodline, well, you can have all the matrimonial assets because that person's got the benefit of the trust. So it's still taken in the divvying up. It's just that you can't, they can't say. So if they've got no other assets that work.
So have you seen decisions or judgments in that favour?
I only heard it from reputable
sources. But point taken. I mean, we're obviously aware of blood trust, lineage trusts, where it follows a lineage of the family, and that's a way of keeping that asset that may have been held prior to the relationship being formed, and they want to sort of put some protection around that, as opposed to a prenup agreements or sort of love and affection agreements, whatever you want to call them, before everything goes pear-shaped for some households. So that's a fascinating.
Well, I think a prenup is probably the way to approach this than trying anything else.
Okay, yeah, fair point. Thank you.
Now, I might add that when you're going to transfer into any of these trusts or companies, and that's the sale of the property to a different entity. So you've got your capital gains tax, your stamp duty, and the like.
Yeah, very expensive idea to be moving property assets around. Does not work.
No.
No, it might not work anyway.
All right, let's see if we can give away some more books here. Damien Ratcliffe has said, and this is regarding tax depreciation, is there any point in getting a tax depreciation schedule anymore for existing fixtures since the recent changes? Julia.
Right. If you continuously own that property as a rental since before the changes, which was May 2017, then yes. When it comes to plant and equipment, but you're really actually allowed to estimate the second-hand value yourself. It's the building you really need a quantity surveyor for. But the building is still claimable. So, that's where you go to your quantity surveyor. So you need the building. If it was built or renovated in some way after the 16th of September 1987, then you need a quantity surveyor report to claim building depreciation unless you know the actual cost of the building.
Yep, I couldn't have said it better. It's I still think.
I'm glad you agree, Ben.
You've got to
part-time accountant over here.
Yeah. Well, what I was highlighting is a lot of people give up on it, thinking that that. So that's my message around. Couldn't have said it better. Get on a calculator, work out roughly if it is. If you've had some type of work done on the property, it's more than likely that the depreciation cost to get it done is going to be less than what you can claim. So you're leaving money on the table is where I'm going with that. I'm certainly not trying to say I couldn't have said it better in terms of describing it, but people are leaving money on the table when it comes to depreciation, thinking that they can't do depreciation on an existing property when they can. And you've just heard it from the best tax advisor in the country on this stuff.
Hey, Julie, we've got one from Paul John here, which I think you've touched on before. It says, any point getting a depreciation schedule done on a brand new build investment property, considering I can just give my accountant the exact costings to build to depreciate? I think before you said that that's something that you're capable of. But what if they were to buy, say, a brand new townhouse or off the plan apartment where it's not as clear what the build is? That'd be a time when you'd get that right?
Yeah, well, sometimes the body court can give you, but what your issue is, you've got to separate the plant and equipment regardless, even though it's brand new and you can still claim the plant and equipment. You've got to separate it from the actual building construction costs. And that is your problem. That's where you need. Now, if you Google ATO rental property guide, at the back of that booklet is a table of all the things, right down to tap fittings and all that. It can tell you whether they're normal plant and equipment or whether they're part of the building. If you've got enough detail, you can use that to break it up. But that's your problem. Do you really have a price list that'll tell you? Do you have that detail? Probably not, and that's why you need the quantity surveyor report. But ask the builder if they can give it to you. You can use it.
Yep. Very good. We'll put that link into the show notes. Yep. That rental property guide.
This one's from Pete Mann, and again, this is a question to see if there's anything that we've missed out, because we have covered parts of this, but I want to know, am I able to claim tax deductions if I rent out 1 or 2 bedrooms in my home? If I rent out 2 bedrooms in my 3-bedroom home, am I able to claim 2/3 of my rates and strata, etc.?
That's right, and cop 2/3 of your capital gains tax main residence exemption lost.
Talk to your accountant and get the.
And you also reset it to market value at that time you first earn income off it, even though it's only part of it you're renting it out.
There you go, Pete. Good question. Book coming to you. Matthew Durrington said, when renovating an investment property, to what level must you renovate the investment property so it can be classed as a substantial renovation to allow you to claim it as a depreciating asset?
Okay, I think there's been a bit of a misunderstanding with this one. So substantial renovation, first of all, I'm assuming they're going to rent it out. They're not going to sell it, so I can eliminate a whole lot from this. So the only reason you need it to be a substantial renovation in regard to depreciation is if you want to claim the plant and equipment and the builder bought it. So, you know how you can't claim second-hand plant and equipment anymore? If it's not a substantial renovation, then the builder buys the stove and then charges you for it. Even though the stove's never been used, it's second-hand in your hands, unless it's a substantial renovation.
Yeah.
Now, do you want me to define that?
Yeah, I think that's probably what Matthew's may be looking for, is what defines a substantial renovation.
Well, the ruling on that is GSTR 2003/3, and it goes on and on and on. So GSTR 2003/3. It goes on and on and on. But basically, it's got to substantially affect all of the house. So just painting the walls in all the rooms and renovating the bathroom and the kitchen would not be a substantial renovation. Even though every room's affected, it's not substantial in most of the rooms. By the same token, you might even be able to double the size of the house, providing it's just an extension out the back and you haven't done anything to the front of it. And that still might not be substantial because you haven't affected all the house.
Wow, that's interesting.
It's good information.
But there's a lot more in that ruling because it is, as they do with tax law, try and make it so complicated so in an audit situation they can get you.
I like the way you look at it.
I think you can see which side Julia sits on the fence, can't you? There, right? She's one for the consumer.
All right, we're bringing it home here. See if we can get these last few done. Andrew McFadden would love to know if we have any further clarification on the possible negative gearing changes from Labor. Are we able to still offset our income with interest down to 0, but not claim it as a loss? I.e. negative gearing, or is there any plans to take away claiming the interest charges at all? So all income is classed as income. Julia, crystal ball.
Yeah. No. It's we do have a problem in that the Labor Party's website says one thing. Chris Bowen's office will tell you a different thing depending on what day of the week it is. But one thing we are. Yeah.
No, I'm laughing because I know.
read Chris Bowen's office and I say, so did I.
Yeah. This is a big challenge for us. We are, if I put my picker hat on, so one day this is happening, next day, that was my next question for you around, can you explain to me the detail of their policy? Because nobody, even people are saying, I was speaking to a CEO of a particular real estate association in the country last week, and they were like, "I know it's only on property; it's not on shares." I've been told it's on shares. Does anyone know is it on shares or on property? Is it? And no one really knows. So I would love for you to give me your best definition of what their policy is to the level of detail that you know it, because I think it's policy on the run.
Yeah, okay, well, there is one thing that it is up there on their side. So I'll start with the grandfathering provisions, right? So with that 30% tax on trust distributions, that's not going to get grandfathering. So everyone that's listening that has a property now before the election does not have to worry about these negative gearing things with interest, right? So it's not just interest. So interest is still tax deductible against the rent. If you buy the property after these things come in, then if the expenses relating to the property, whatever they be, even if it's not interest, if it's repairs or something, which is a problem if it's repairs, isn't it? You've had a bad tenant. If they go higher than the rent you receive, well, you can't claim that deduction for that amount. That's quarantined. Now, the uncertainty that we're getting contradictions on is the ALP website does say that would be, then goes in your cost base, the bit that you couldn't claim. But Chris Bowen's office has said two different things, and one of them was, but no, you can save it to offset against future income. Now, remember, these things have to get through Parliament, they have to get through the Senate. To actually put that in cost base, when you think about the situation where a person has a big bad repair year and then it goes on all right, that's not very fair, is it? Because the tenant trashed the place. So I imagine there'll be lobbying, and there'll be, as with all legislation, and hopefully they will say, all right, we'll let you save it until you do start making a profit, than shoving it down the cost base where it may never get recognised. Because people that have to cop up for these huge repairs need the tax break, don't they? Somewhere along the line.
Yeah, I'd like to think that it is a carried forward loss that you can offset against future positive income. That would make more sense than to add it to the cost base. But again, it's just uncertainty. I mean, you know, he was on this. Yeah.
It is uncertain, but their website does say that it's going in your cost base. So I'm just hoping sense prevails in that regard.
Very good. Thank you, Andrew. I've got one here from Nick Allen. How do I transition my investment property out of retirement with minimal tax impact?
Right. Retirement doesn't cause a tax impact unless it's in a super fund. So I imagine we're talking about selling here. So the minimum tax impact would be waiting until you retire and in a lower tax bracket before you sell. But the trap here is that if you're over 65 and you've stopped working, you can't make your 25,000 contribution to super to offset the capital gain. So it's a very delicate balance. You need advice at the time depending on your age, but that's really all you're playing with there.
Okay.
Yeah, I think they're probably not thinking that I'll just grab the property that I own in my personal name and I'll just throw it in my super. This is some of the level of lack of knowledge of people out there. You know, again, transferring ownership is expensive. You're in it for the long haul once you decide which vehicle you're going to use, whether it's personal name or whether it's trust or self-managed super fund or company. And we know with super funds, one thing's absolutely for sure, there'll always be bloody changes. Yeah. Every bloody year in the budget.
Also with super funds, you can't transfer residential property that you already own into your own super fund. So that wouldn't be a strategy anyway. You would pay the tax.
Hey, Julia, this one's from Costa Docalas. What implications must we consider if we go down the short-let Airbnb route?
Right. You were talking before about putting things in notes or something. I have a fantastic blog up on our website.
Yeah.
You could put that in there with Airbnb. So it's all about keeping records. Now, if it's just an investment property that you're going to rent out holter-spolters, then you don't have any of those issues we're talking about that you're sharing your house with anyone or stuff like that. So you just keep records like you normally would with an investment property, but there might be a bit more because you're buying soap and little coffee things, and that's a bit messier. You're getting cleaners in. But yeah, it's the same sort of thing. It's only when you're with your home, and we've already discussed a lot of that, where you've got to keep all those records. It's affected you for capital gains tax. And a little trick that some people think they can get away with, which we all thought was fair and reasonable, that this absence rule we talked about, that you're going away overseas for a month, so you rent your house out on Airbnb while you're overseas and get a bit of money while you're there. If you do it at the right time of year, it's ideal. The tax officers recently, we've been nagging them for years, they finally gave us an answer on it. I had to get Noel to hassle the media unit to get the answer. They didn't want to give it to us. They argued with me. I put it in a personal ruling, and they argued with me, we don't have to tell you the answer to that until you sell the property, because you don't need till then to calculate. So it's no need to know yet.
Yeah, nothing to do with planning in advance. What are they thinking? Yeah.
So the issue is the legislation requires it to cease being your home to get that 6-year rule. Now, if it's still your address on the electoral roll and there's still some personal effects there, and you don't have another home, you're just travelling around the country, then it hasn't ceased to be your home. So you're in the same problem, even though you're absent, you're in the same problem as you would be if you had people renting a couple of rooms off you. Proportionally, you reset it to market value at the time you do that, and then you have to apportion everything from going forward.
Okay, so we will put that up so we can get access to that. Thank you. And to bring it home, I've got 3 questions that are all in the same family of questions. So I'll read them out. One's from Sandy Santich. How to choose, find a quality property investment savvy tax accountant. From Seneth Wijiskara. Sorry, Seneth, I've butchered your surname, but that was my best effort. How to differentiate between investment savvy specialist tax agent and general tax agent. What outcome does your investment savvy tax agent bring to the table? And then Ian Hunt, what sort of benefits could one expect from a property investment savvy specialist tax agent over a generalist doing it yourself? Can you bring it home with probably selling your services here, Julia, but if you could do it in an objective way, that would be wonderful.
Okay. Doing it yourself, really? Really? So how are you going to keep up to date on all these latest changes? How do you differentiate between a repair and an improvement? That sort of stuff. Yeah. We've already said, it shouldn't matter as long as they've got experience with rental properties, because let's face it, guys, there's a lot of emotional stuff that goes on. You got to talk the talk. You don't have to have a lot, because accountants can make much better money out of reinvesting in their own practice than going to property. So that's just as long as they've got experience. My ideal test, before you go and buy a property, go along to an accountant and say, well, what do I need to know? And do they take you through and crunch the numbers and tell you how much it's going to cost you to hold? Can they have a sensible conversation with you about what name to buy it in? That sort of stuff. And you haven't really committed at that stage, but you get to see whether they can talk the talk.
Mm. And that's essentially how you differentiate, is what you're saying, in terms of make sure that they can maybe get up on a whiteboard and explain a few things. And your point is it doesn't necessarily need your tax agent, your property savvy tax agent to have a big swag of properties. They just need to know what they're talking about. Is that your view?
I know what it's like to have the ups and downs of it, but Ben stole my punchline earlier on. You can always walk in and say, well, what happens when I repair a fence?
Sorry about that. I had no idea.
Welcome to my world, Julia.
But it does highlight the importance of the how many volumes of the Tax Act are there, Julia? Is it like 35 volumes or something like that? It's something ridiculous, isn't it? Like in terms
There's some quote I remember having ages ago. I think it's in the first book. That if they worked out that if you read them all from front to back or something, it would take more than a lifetime, and it would something about if it continues to grow at the same rate it's growing, it'd take several aircraft carriers to actually cart it around, and there's some ridiculous things there.
We don't need tax reform in this country. I mean, who would have thought? It is just an antiquated, ridiculous tax system that we have in this country. But no governments, no leaders showing leadership and telling us how we can fix this tax system. So we just keep adding and adding and adding. I reckon if you did put all the pages together, you'd probably put a page from here to the moon, right? It's that ridiculous. Now that's obviously an exaggeration.
Bring back the great Paul Keating. He's the great tax reformist of our time.
Wow, he was a productivity reformist. More than a tax reformist, he was the one that he was the one that banned negative gearing for a short period of time. So he made a couple of mistakes along the journey, but he certainly was a very good treasurer, and that whole Reform Act that they did back in those days certainly kicked the economy along.
Had the foresight to bring it back in 2 years later, though. So.
Yeah, because we haven't asked that final question of you, and what do you think about the tax policy that Labor is presenting, Julia?
I have problems with nearly every part of it, but there's a couple of parts of it that show that they don't understand. And that's what I was going to say. That's why we're in such a mess, because our legislators don't understand. Now, Paul Keating did. He wrote our capital gains tax provisions, and they're good. They're really, and they're clear and they're concise, but the rest of it, yeah, it's brought in and it's compromises. People sit in Parliament and they argue this and they have their 3-word slogans and they just wear each other down until they come up with something. And we're left to decipher it. We're left with things that they say in Parliament are going to happen and never get through, but we've still got to prepare tax returns as if they have got through, because they can never work out how to put it into law. Don't get me started.
Come on, Julia, tell us what you really think. Come on.
So what do you think it's going to do to property prices and rental?
Well, one would expect that people are buying now for the grandfathering provisions if they're going to buy. Certainly there's going to be a shortage of supply, but fiddling with houses, you're fiddling with the bank's balance sheet, you're fiddling with the average person's wealth, you're fiddling with the most fundamental part of our economy. And they keep on going, hey, look at me, I can beat it better, I can really destroy it better, I'll bring in even worse laws, don't they?
Oh, this makes for great video. So we're going to have to put that somewhere on. That's a great. But it's true. I mean, here you are, 53% of all households' wealth are stored in property in this country. And you think it's a good idea to bring the value of it down for everyone.
Yeah, you used to say the value of the family home was protected at the ballot box, but not this year.
Mm-hmm.
But why not decentralise? All of this is, in my opinion, so the wealthy living in Sydney can get some low-income labour to smash up their avocados for them so they can have a cheap coffee. If it becomes too hard for people to be able to afford in Sydney, so they move out to Bathurst. And that becomes a growing metropolis, and people in Sydney will have to pay more for the unskilled jobs.
There we go.
Well said, wise words.
Natural thing.
Hey Julia, we've certainly tapped into your expertise on today's show, so thank you for that. We covered a fair bit of ground. You were very, very good at letting us just fire heaps at you under some certain topics. So thanks very much for coming on to the Property Couch. You're always welcome here. Thanks for the contribution you made over a number of decades, and keep doing what you're doing. You're doing great stuff.
And can I just say, because of the complexity of some of those questions, we did send some of those questions to Julia because of the level of detail that goes in there. So with your permission, Julia, can we share your responses so people can refer back to them and have a look at your full answers to some of those questions?
Oh, certainly direct to the people. I don't know whether my grammar was perfect because they were notes for myself, but I don't mind them. Get the information out there, please.
Brilliant. Yeah, thank you very much for that. That's wonderful.
Well, thanks again, Julia. You were terrific today. We appreciate your time, and we look forward to catching up on the next time we are inundated with tax-related questions that only you can answer. So, thanks again, and we'll catch you at some stage soon.
Thank you very much. Thanks for having me, and I'm sure we'll need another update after the election.
Yeah, it looks like that's when we will catch up. But thanks again. We'll chat soon.
There you go, mate. Completion of what was a very, very thorough and comprehensive interview with Julia.
It was terrific, and it just also shows you, we've had some great responses to part one. So we were keen to get part two out, but obviously there's a big story here on taxes everywhere. But it just goes to show you the complexity of tax and the complexity and the nuances that you need to understand. So we always say go and speak to a tax agent who specialises, subject matter expert in residential property, and you'll be well served. So, and also just, the last bit there, remember this was pre-recorded, as we've talked about. She talked about the ALP website and Chris Bowen's website.
They can still go there, can't they?
What's that?
They can still go there and check those out, couldn't they?
They can, but there's a lot less information on there than what there was before, as we just mentioned earlier in the show. So a growing conversation. If anyone has more tax questions, we love doing the Q&A sessions. So
we're going to do more of them.
We'll do more of them.
And I've got to say, it did remind me of the sort of 1993 to 1996 when I'm in the Murdoch University Library studied Tax Act to get my accounting degree. There was a bit of a shudder at some points in that, but
very good.
Oh, you weren't going anywhere.
Well,
that was a big one.
That was a big one. Well, the other thing that I also want to let listeners know is we have written to ask more questions through the journalists around, the subject matter around the negative gearing is still questionable in terms of we want to know what happens if you're buying a company, what happens if you're buying a trust, what's the definition of when you're buying, like we were talking on Ross Greenwood show, we got the question around what if I own a property and turn it into an investment property after the 1st of January. So, they are talking about grandfathered. Their statement says that if you have purchased a property prior to that, but if it's not currently an investment property, they don't. So there's a lot of questions we have. So hopefully we'll be able to get those answers to you so you can make an informed decision coming up to election day.
Here. So folks, we've also got with permission from Julia, we can actually give you all of the written answers to all of those questions. So there'll be deets in the show notes. I'm sure I've just put it up on Facebook if it's not already. So you guys can get that and read it at your leisure, Ben, so that you can have another look at that. So
beautiful.
Hey, my life hack today, Ben, is I've been lately going through organising iPhones. So I stumbled across this nice little way for you to organise your apps, Ben.
You're right.
Homepage is all the tools that you need.
Yep.
The second page is just full of folders. So all of the apps should be in folders.
Yep.
And then third page should be junk. You shouldn't be spilling over to any more than that. So
an enhancement on what you said last week or the week before?
Yes. Well, exactly.
Yeah,
so it's a 30,000
foot view.
Put
your socials across to the other pages in their folders. Yep.
Yeah. So the junk. So then I dived into that a bit more because I haven't done this, but I'm thinking that I will.
Yep.
So the junk is all of those for Apple users, Ivis. You can help me out with the Android. If all the ones that you just can't delete, that Apple says you just cannot delete, but you never use, just chuck them in the junk drawer. So page 3 is junk drawer.
Yep.
Page 2 is apps, full of folders, shouldn't spill over to another page.
Yep.
And then the home page is
all
for
your
all
active
your
ones.
active tools,
Love
active
it.
learning, all that sort of stuff. So,
Beautiful.
Did you know?
So I've got a couple of things to say for the Did You Know. Still on the tax story, still on the whole negative gearing thing and the whole thing we don't like about property, new property, off the plan property. So you may have heard this on Ross Greenwood, or I may have said it in brief, but I'm going to dive deeper into the perils of buying off the plan property, which was a research piece done by BIS Oxford Economics. It was released a couple of months ago, and I'm just going to summarise quickly what it talked about. So since 2011, they analysed every off-the-plan purchase in Melbourne and Brisbane, and in Sydney they did it from 2015.
Sure.
So they got the data, they got the best data they could get their hands on, and so these were the conclusions. From 2011 for Melbourne, 66%, 2 out of 3, Bryce, properties bought off the plan have had zero or negative growth. 0 or negative growth. Wow. 2 out of 3.
Compelling story.
Compelling story. Second, Brisbane. What did they have?
Well, that's a bit unfair, isn't it?
Straight off it. 48%.
48, that's what I was going to say.
1 out of 2. 1 out of 2 have had zero or negative equity growth. In Sydney, during a booming time where unit prices have been growing strongly in that market.
36.
23.
Oh, okay.
So 1 in 4 roughly, 1 in 4 of properties have had zero or negative, and that's deteriorating further because obviously property prices are going down, especially in the unit market because of an oversupply story up there. So that's with existing negative gearing in play. All right, so that secondary market's going to support those values. So you take that secondary market. So when Labor says it's all grandfathered, it's not going to have any impact. Absolutely, it's going to have an impact, right? Because you're taking away that secondary buyer for that property straight at that point. So you are absolutely impacting the property value. You may not be impacting my tax offset, but that tax offset's only a short-term thing anyway. Right, so hopefully longer term I'm producing cash flow from that property and it's supplementing my income in retirement. So, it just goes to show you, and we've been on this program, for several years now, talking about the challenges. We're not saying that every off-the-plan purchase is going to be a dud, but the mass-produced, very simplistic stock that is positioned for investors for negative gearing benefits, all right, has delivered very poorly for those investors, and they should be aware that not all property is created equal, which is a great segue into some of the stuff I've been seeing as I've been sort of doing a bit of keyboard warrior stuff, Bryce.
Can I just quickly jump in
Sure.
there? Do you remember the analogy we used to always use for brand new? It was a bit like buying a brand new car. As soon as you drive it off the lot,
Yep.
it loses its value.
Yep.
The sub-note to that was, but it's real estate, so eventually it will, over time, should at least get back to where you purchased it.
Yeah.
Well, under the new policy, it's probably exactly the same as a brand new car, because it will never be as high value as the day that you settled, because if there's no secondary market for it outside of owner occupiers who have traditionally not gone for that type of stock, the value doesn't recover.
Yeah.
So the analogy needs an update.
Well, and that's
under
why
that policy.
Yeah, and that's why master builders have said this is bad, right? And all of the big developers are going, this isn't good, because once the mass market knows that it's so poor, they'll just deviate from buying that stock and basically invest in shares or look at alternative investments as opposed to property. So then the supply constraint occurs. Rents go up, but people are still very scared in terms of buying that asset class, and they're getting better at it. Even though, around 45% have been buying new, that also includes house and land packages, and they might not be as bad because they're underpinned by land.
Yep.
So I still think that it will be an appreciating asset, but you may only get inflationary growth as opposed to any true capital growth. So, Cameron Kusher said that last night. He was like, it's not as extreme as a car example, but it's not far off in the sense that a builder, and you've always talked about this, don't buy their profit, right? They'll always pitch it at a higher price point, but the market will tell you what it's truly worth. And that's why we've always bought, properties that have proven resale.
Second and subsequent purchases.
Yeah, second and subsequent purchases, so we can get a sense of what the market's telling us it's really worth. So that's an important point. But as I was saying, with my keyboard warrior stuff, I'll tell you what I have noticed, is the sales spruikers are in there. They're in there, Bryce. They are like, I've seen a few
Moth to a
emails,
flame.
just buy new.
Yeah.
News where you guarantee yourself negative gearing, it's a right way to go. It's all, self-fulfilling for them in terms of self-interest, right? So I've noticed a couple of ways in which they're doing it. Some are saying, put it beyond doubt, always buy new. And I'm thinking, that's rubbish. And second to that, I've had one particular gentleman saying, I've got some off-market opportunities, some new off-market opportunities. So he's using what buyers agents can potentially do in terms of off-market, pre-market for existing property, and he's spinning that story into a marketing story. Hey, come to me. Some developers are giving me some stock that's off-market. Not off-market, I tell you. That whether they can't afford to advertise it, right? But they're oversupplied with it, so it's quite dangerous. So my tip to people is do not, under any circumstance, take an opportunity to buy brand new where it's claimed to be an off-market.
Look,
And
most brand new is off-market, Ben. Think it through. Like
Exactly.
most of the developers are paying marketing companies, project marketers,
Yes.
to move their stock through non-traditional channels.
So it's not on realestate.com, it's not on domain.com, not on all those places. So I think it's a clever bit of marketing, but that's what they are good at, right? So that's just a public announcement in terms of watch out for those spruikers who are telling you that the best way to go is new because you get negative gearing benefits. We've said all along, negative gearing is not a strategy. It's a moment in time. It helps people get into the marketplace.
It's a tax outcome.
Yeah, it's a tax outcome, and we're just saying that Labor's policy, not so much negative, Labor's policy is wrong and it's constructed in the wrong way, and it can be improved. And that's been our message from day one.
All right, well said. So there you go, folks. Hopefully you've enjoyed that episode. Well, that's in fact two-part series with Julia. We enjoyed spending time with her and going through a very complex matter, and hopefully she's made it easy for you, Ben. But till next week.
Knowledge is empowering, Bryce, but only if you act on it.
See you, folks. Hey there, folks. Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.